Kroger is an American company that operates supermarkets, and over the past year, they are up by 37.15%. Now, over the past 5 years, they have been rising very steadily and are up by almost 120%. And so, in today's video, we will figure out if this steady rise is rationalized and if Kroger is set to keep growing in price into the future, and if buying it now will still yield you return. So, first of all, jumping to our stock screen, we can see that Kroger has a dividend yield of 2.08%. with a low trailing free cash flow payout ratio of only 24.71%. Now, jumping straight to the 9 pillars, we can see that Kroger gets a rating of 9 out of 9 with all the pillars in the green. Right away, we can see the very juicy consecutive dividend growth sitting at 14.59% yearly over the past 5 years. And if we have a closer look, we can see that that is more than 3 times the average, and Kroger has actually increased their dividend by more than 100% over the past 6 years. Now, jumping back, let's have a look at the growth of Kroger. They have been growing their revenue at a rate of 4.21%, and they have been increasing their free cash flow as well as their net income. But if we have a closer look at the net income growth, we can see that it has been quite volatile over the past 5 years. It certainly isn't growing at a rate of 13%, but it did increase from 2019 to 2023, and year over year it increased by another 27.87%, and that is the same case with the free cash flow. So we can see that they have growth, but their growth isn't as excellent. Now, one thing I love about Kroger is their low 5-year PE ratio and their very low price to free cash flow, because over the past 5 years, investors were paying only $12.80 for a single dollar of Kroger's earnings, which is less than what they would pay for the earnings of an average company. And this is the same case with the free cash flow, where investors were again underpaying for the company's free cash flow. Now, another thing I love about the company is that they have decreasing shares outstanding at a rate of 2% over the past 5 years, by which they are increasing the value of the leftover shares outstanding. Their 5-year profit margin is also sitting in the range we like to see, and their long-term liabilities over the 5-year free cash flow negative dividends is sitting at 2.46, which means that they can pay off all their long-term liabilities with their free cash flow in about 12.5 years. And now let's calculate Kroger's intrinsic value, first using the Graham's formula revised. And here we plug in the 5-year earnings growth estimate at 6.36% yearly and get an intrinsic value of $50.64. Now, for the second valuation model, we have a look at the free cash flow of the company. We calculate the growth rate into the future of 5.7%, plug in a discount rate at almost 6%, and get an intrinsic value of $115.92. Now, for the multiples valuation, we compare Kroger to 4 of its competitors and get an intrinsic value of $84.68. And finally, we will compare Kroger compared to their dividends. We will project a growth rate of 14.33% into the future, and using our alternative model, get an intrinsic value of $60.41. And finally, arriving to our ultimate valuation, we average out these 4 valuation models and get an intrinsic value of $77.91, which is 27.14% higher than the current trading price. And with a margin of safety of 25%, we get an acceptable buy price at $58.43. Now, in my eyes, Kroger is looking very nice. They have very nice steady dividend growth, and they are growing, although at a very low rate. Now, something you do have to take into account is that the growth of the stock price of the company is a reflection of their profits growth. And so if Kroger will grow at lower rates over the next few years, you cannot expect high returns, but that is compensated for with their high dividend growth. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.